Welcome to Accounting with Audra, and the first episode in a new series on foreign tax credits. What is a foreign tax credit, and how does it impact the overall tax posture of a global company? Well, in prior videos, I have discussed how U.S. companies over time have broadened their consumer base across the globe. This has in turn added complexity to where companies pay tax, as well as how much they pay in tax. Furthermore, U.S. companies pay tax not only on the taxes they earn onshore in the U.S., but may be required to pay tax on earnings from offshore activities. Foreign branches can be subject to double taxation. Additionally, the foreign operations of a U.S. company may be subject to tax on foreign earnings as a result of various anti-deferral regimes such as the Subpart F income, investment in U.S. property, and GILTI. Please see my other videos where I walk through the concept of Subpart F and GILTI in greater detail. Without a foreign tax credit, much of those earnings from overseas would be taxed twice. We call this double taxation. Let's look at a simple example to illustrate. Let's assume that a U.S. company wholly owns a foreign company. The foreign company earns $100 overseas and is subject to a 20% statutory tax rate on those earnings. Let's also assume, due to the GILTI rules, all $80 of after-tax earnings are subject to tax in the U.S. The current tax rate at the time of this video in the U.S. is 21%. Without any sort of credit mechanism, the foreign corporation is essentially subject to double taxation. It'll pay $20 to the local government, and the U.S. parent will pay an additional $16.80 to the U.S. government. Total taxes paid on $100 of earnings is $36.80, and the effective tax rate on those earnings is 36.8%, well above both the local and U.S. statutory tax rates. The U.S.'s enactment of the foreign tax credit rules was aimed at helping U.S. companies be more competitive globally, by providing a credit to the extent income is subject to tax in the jurisdiction. In theory, using example 1, the U.S. tax of $16.80 should be offset by the local taxes paid. In the example, since the $20 is higher than the 16.8, the U.S. wanted to ensure taxpayers could reduce their liability to zero and not end up with a refund. Application of the rules technically would limit the credit, so if the foreign country's tax rate is greater than the U.S., no residual tax would be due. And if the foreign tax was less than the U.S. tax, only taxes would be due to effectively result in an overall 21% tax rate. Before getting into the basics of the computation, it's important to understand that the foreign tax credit rules are elective annually by U.S. taxpayers. In other words, if you do not believe you could get a credit, or if you cannot administratively do the computation, you are able to deduct the local taxes paid in the U.S. Looking back in our example, you're taxed on only the $80 and not the gross $100 of earnings in the U.S. The main code section allowing taxpayers to take a credit is IRC Section 901. That section states that a domestic corporation can credit any income or profits and excess profit taxes paid or accrued during a taxable year to any foreign country or to any possession of the United States. The amount allowed is subject to the limitation of IRC Section 904. This series will first focus on the limitation under Section 904, and then I'll separately cover what constitutes an income tax for purposes of the foreign tax credit. Historically, many companies spent significant time on computing the limitation under the regs. However, recent rules have become even more complex since Treasury has passed new regulations adding additional limitations on what is actually an income tax for purposes of the credit. I like to break the foreign tax credit rules down into 6 concepts or steps. The first 2, determining whether you can credit taxes paid in foreign jurisdictions under 901 and 960. And the second one, which is consider your U.S. tax posture and whether you will actually be paying U.S. tax now or within the foreseeable future, are important because if you answer no to either of these questions, you most likely would not need to consider the computation, or at least not in the current year. Once you determine a foreign tax credit may be beneficial based on answering yes to these 2 questions, the overall calculation can be boiled down into an additional 3, 4, 5, and 6, which I'll talk about here. This is kind of my way of thinking through this calculation as I look at it on a company by company situation. So in item 3, This is where you would then determine what is foreign source income that is reported on your annual tax return, and what we call source that income by basket, which we'll get to in future videos. Fourth, you then allocate and apportion expenses. Again, those expenses are those which are reflected on your US return to the foreign source income. And the fifth kind of step, you then compute the foreign source income limitation by basket and apply what are known as the loss ordering rules. And then finally, in step 6, you use the limitation that you've determined using 3, 4, and 5 to figure out your current year credit or the carryover of any unused credits. The limitation formula is summarized as the net foreign source income, which we will discuss in video 2, by basket over total taxable income times U.S. tax before consideration of credits like the R&D credit. To create a complete picture in this overview video, let's walk through a few simple examples of how the tax credit rules work, applying the 6-step process that I just laid out. Assume a U.S. company reports on its 11/20 $1 million of gross sales, $20,000 of royalties received from its wholly owned foreign subsidiary, and it incurs expenses of $300,000. Again, this is on the U.S. 11/20. Also assume that the $20,000 of royalty income received is subject to a withholding tax of 10% upon payment. Revisiting the basic steps I outlined previously, we 1, confirm we are paying foreign taxes, and 2, will incur tax in the U.S. So then it makes sense to move forward in additional analysis. Our U.S. taxable income of $720,000 is subject to a tax rate of 21%, which should result in $151,200 of tax in the U.S. So since we answered questions 1 and 2 as yes, it's worth going through the FTC rules to determine whether we can take a credit. Item 3 would require us to determine what our foreign source income on the U.S. return is. In this case, the royalties received are foreign source income. In video 2, I'll explain how to source income in greater detail. All other income is U.S. source. Let's also assume after we apply the appropriate rules for allocating and apportioning expenses, we determine that $5,000 of deductions taken on the U.S. return relate to the production of that royalty income under step 4 of the process. We can then sum up our income in the U.S. in foreign categories. In this case, we're just dealing with one category of income to get our limitation under step 5. In step 6, we then do our limitation calc. $15,000 of foreign income divided by $720,000 of total income times our U.S. tax of $151,200 will give us a limitation of $31,752. This is then used to determine the actual credit that can be taken in step 6. Since foreign taxes paid on royalties is $2,000, we're limited to a credit of $2,000. If our limitation was less than $2,000, we would only be able to take the limitation as our credit. And then we would be able to carry back or carry forward any of those unused credits. In following videos, I will walk through the various rules necessary to source income, such as royalties, interest, services, subpart F income, and GILTI, highlight some of the more common expense apportionment rules, explain how income and expenses are sourced to various baskets to determine the limitation amount, explain how, to the extent losses are computed, they impact the computation, and then finally talk about various items of it that need to be considered when determining whether a tax is creditable. If you found this video useful and would like to be notified of future videos, please subscribe to my channel. As always, your comments, questions, and feedback are greatly appreciated.